Good afternoon, everyone. Welcome to the third quarter 2018 Market and Economic Review hosted by the Bernie Company. My name is Bijal Patel, and I'm a Senior Wealth Advisor on the team. I'm joined today by other senior team members, Lowell Pratt, Adam Newman, and Andy Pratt. We thank you for taking your time today to join us. Before we jump into today's content prepared, I'd like to go over a couple of housekeeping items. First, we've allotted 1 hour for the webinar, with the first 40 to 45 minutes being content presented by our team, and the remainder of the time for Q&A. Questions can be submitted throughout the presentation, but to keep to our schedule, we'll hold off on addressing them till the very end. You can submit your questions by selecting the Q&A icon on the top left-hand corner of your screen. Any questions we don't get to by the end of our time today, we will address as part of a follow-up, which will be outlined at the end of the presentation. Today's presentation is a look back at the third quarter. However, over the last 3 weeks, the markets have been making headlines. The Dow down 1,000 points. October fear in the market. So before we get started, I'd like to turn the floor over to Lowell, who'd like to make some comments.
Thank you, Bijal. During the 32 plus years I've been at the Bernie Company, I've been involved with lots of different kinds of markets, many of them nice and calm like the third quarter, others not so calm. It's always a little more shocking when you get the volatility that's natural to the market after a long period of relative quiet. But it's important to understand that volatility is a necessary part of the market. If you think about volatility from the double-edged sword side of things, it's negative as it occurs. Obviously, we all feel the scare and the emotion that goes with it. But it's also that scare and that emotion that drives the excess return that equities are accorded because of that volatility. So, kind of saying that another way, if the market suddenly lost all of its volatility, the 5 percentage points of excess return that equities earn over time would diminish in proportion to that lessening of volatility. So particularly in this environment where return is so hard to capture, we need to keep in mind the fact that not everything about volatility is necessarily negative.
Thanks, Lowell. So I'm going to go ahead and turn over the floor to Adam, who's going to give us a market and economic review.
Yep, thanks, Bijal. And to kick things off, what I want to do is take two different views at what's happened market-wide across asset classes, both for the quarter that just ended in September, Q3, and also from a year-to-date perspective to capture some of the recent volatility. So what I have here is what we consider to be the 6 broad asset classes. These are the asset classes that are most well-known to investors and that are tracked most frequently. So I've got the stock asset classes listed on the left. We've got the U.S. market, international developed stocks. These are regions like Japan, most of Europe, Australia, Canada, developed overseas countries. We've got the emerging markets, which are those up-and-coming economies, most prominent being India, China, Brazil, and Russia. We've got the global real estate market. And then to the right, we've got the bond market, both the U.S. bond market and the global bond market, which are, bonds issued globally outside of the United States. And so what you can see here is just the performance for the quarter, ending September 30th. The U.S. market, which has been a continued theme, has really been the top performing asset class on a year-to-date basis and just for the quarter and for the rolling past several years. The S&P 500 index actually logged its biggest quarterly advance in 5 years this past quarter, up just over 7%. From a sector standpoint, the healthcare stocks really drove a nice portion of that return, while the materials and the energy sectors were the laggards that had not only the most volatility, but some of the lowest returns. And from a growth to value standpoint, which Andy will touch on in a little bit, growth stocks, again, continued the trend that we've seen in outperformed value. So if we take this and we look at it from a year-to-date perspective, looking through yesterday's market close, and today we've got some more choppiness, but if we look at it through yesterday's close, we can see how things have transpired, through, almost the first full 10 months of the year. The U.S. stock market, and this captures large and small caps, is up mid-single digits, just around 4%. But almost every other asset class has faced some serious headwinds throughout this volatility. So this trend of the U.S. market being the only positive in the strongest asset class, this has been a multi-year thing that we've seen rolling through time. But to put some historical perspective to it, we know that asset classes change leadership through time, and you can see some of the characteristics going back to, really around January 2001. Some of the best case, worst case scenarios for these asset classes. You can see their comparative volatility and the comparative returns. But we understand and acknowledge a lot of our clients have exposure to their portfolios outside of just the U.S. market. So this gives you some context around, what's been happening and what the trend has been. While I talk about the economy briefly, I've got this chart. This is the All World Stock Index. So this is just looking at all of the publicly traded stocks in the world. And you can see from left to right the price movement of this index throughout the quarter. And it's meant to be illustrative in that it's showing you some of the major headlines, globally through the quarter and how that impacted the up and down swings in the market. But a lot of the themes that we saw last quarter, even though this is a more volatile environment that we're in today, these trends and these themes economically have continued, and not much has really changed on that front. So the economic backdrop for the U.S. economy was strong. We had about just over 4% growth in the second quarter. We're still tracking, 3% growth or so 10 years into an expansion. So I think overall, in terms of the health of the economy, that's a great place to be, and that's still supported, in the labor market, which we tracked during our last quarterly conversation, with wage growth slowing down maybe a tad bit, but the overall, you look at new jobs added, you look at the trends, that there is monthly volatility, but the trend is still very strong. And then from a corporate profit standpoint, both top and bottom line, I know we're in the midst of earnings season here, and you hear in the news some names, whether it's been the last couple of days, McDonald's and Caterpillar coming out with different stories from an earnings perspective. But on a net basis, the corporate, earnings environment is strong. We've seen actually S&P 500 profit growth accelerated about 25% over a year-over-year basis. A lot of this led by the technology sector, which, from an earnings standpoint, with the momentum coming behind tech stocks and their continued run, Apple in early August became the first U.S. company to hit a market cap of $1 trillion. So that was one of the many milestones of this bull run that we've been a part of. The other side of it really has been the tax law and how that's trickled down into the economic environment. So the tax cuts definitely get some of the credit for the rise in corporate profitability. So that's the bottom line aspect of it. But on the top line, from a top line perspective, the results continue to be impressive. So revenue growth has still been strong, where we've got year-over-year revenue growth in the S&P up about 10% year-over-year, and that was the biggest bump since 2011. So despite the headwinds and the conversation around interest rates, which drove lots of volatility over the last, let's say, week and a half, despite that, the health of the corporate environment, as proxied by the largest companies, and the labor environment, just the economic backdrop remains strong despite some of these short-term swings. And so with that in mind, and with this as the context, we're going to pass it over to Andy, who's going to talk in more detail about our strategy and how it relates to our size and style positioning, and some of the things that we should look at going forward.
All right. Thank you, Adam, for the introduction. And yes, as Adam mentioned, I'm going to talk about our primary U.S. equity strategy, our size and style responsive strategy. And to give you a quick refresher, what this strategy aims to do is rotate to the size and style market phase that we believe will be in favor in the years ahead. But last quarter we did our first one of these market review webinars, and because it was our first one, I went pretty in depth on what our size and style strategy is. I'm not going to go anywhere near as in depth. Instead, I'm going to give you, sort of a recap of where we are right now in today's. So if you did miss our webinar from last quarter, it is available. And if you would like to, get a deeper understanding again and maybe a refresher on what our U.S. equity strategy aims to do, I'd recommend going back and catching the replay of that. That's actually in our client portal, which is something that we rolled out here in the third quarter. I know we've got many clients who are currently on the portal, but in case you haven't heard about it, I did want to mention that it's there, and it's a great source to access information about your accounts, get your quarterly statements, and receive updates from us. So I'm actually going to, in just a second here, publish a poll, and I'd like everyone who's on the call to go ahead and answer if you could. So my first question is, how many of you on the call even know about the client portal in the first place? And of those who maybe have not signed up for it yet, are you interested in gaining access? I'm going to wait just a second to, let the results filter in here. All right. Great. Yeah, there's still some results filtering in. But yeah, it looks like, some of you know about it, some of you don't know about it. So it's great that you're on this webinar today. It looks like most of you are interested in gaining access. So I'm going to end the polling here now. All right. Yeah. So for those of you who do not have access right now and are interested in gaining access, we're going to flash one of our associates' email addresses at the end of this presentation, Brenna Surrett. She can walk you through kind of what you need to do to gain access, where the links are, things of that nature. So if you are interested, please email either your advisor or Brenna, and we can get you set up with that. All right, so like I said, the two main questions that I want to address with our SSR strategy is, where are we now with the strategy, and how has it been going this year? So many of you might be familiar viewing Size and Style in a box. I think Morningstar is the firm who made this famous. It's sort of a way to show the allocation of a portfolio. It's used a lot of times with mutual funds to kind of show you where your allocations lie. But as you know, our strategy will tilt between large and small caps and value and growth stocks. And to be able to get an idea of where we are today, first you need to get an idea of what is a neutral tilt. So, where would we be invested if we're just trying to get exposure to the market? And this is a box that's designed to show you that. So you'll notice that large caps in our neutral tilt make up the majority of the portfolio, and that's because large cap stocks comprise the majority of the market cap out there in U.S. equity. So it's somewhere around 75% of the U.S. stock market is comprised of large cap stocks. Of course, there's many more names in the smaller and mid cap space, but they just don't make up quite as much market cap. So in order to achieve market returns, you have to weight by market cap. So a neutral tilt here will be about 75% large caps, 25% smaller companies, and about a 50-50 split between value and growth. I'm about to flip the slide, and when I do, I want you to pay attention to the growth column here, as well as the mid and small space. You'll see the percentages go up on both those marks. So this is where we are right now. During the third quarter, actually in the first couple of weeks of July, we finally saw some momentum in small cap space. Prior to that, we were actually neutral with regards to value or growth. So with regards to size. But we've been on this growth bet for some time. And right now it's about 70-30 tilted towards growth. And this reflects our confidence that we expect growth stocks to continue to outperform. And previously we weren't seeing any momentum with regards to small or large. Some months we'd see large caps have the advantage. Other months we'd see small caps have the advantage. They go back and forth. But really at the beginning of the third quarter, some small cap momentum took hold, and part of that makes sense as that was about the time that we saw tariffs coming online, and tariffs tend to affect the bigger companies that have more business internationally, had less impact on U.S. domestic companies, which includes a lot of the small caps. But more so generally, we are more comfortable being invested towards small caps, because over the long run, small cap stocks do enjoy a return premium relative to their large cap peers. So that is one change that we saw in the third quarter. Presented a little bit differently, here are our tilts relative to where a neutral market would be. So the gold bars represent neutral, the blue bars represent where we are now. So it's just another way of showing you that we've come down from our large cap holdings and increased our allocations to smaller companies. And again, everything we do here is market cap weighted. So you'll notice that large cap stocks still have the majority of your assets, but relative to the market as a whole, we've increased our exposure to small caps. And similarly, I wanted to show with regards to style, like I said earlier, we've been on this growth bet for a little bit longer as we've seen growth stocks enjoy the advantage. But again, we're 70% tilted towards growth and 30% tilted towards value in your portfolios. Now, contrary to our positioning on small cap, over the long run, value stocks enjoy the return premium over growth stocks. But the responsive nature of the strategy allows us to tilt towards growth stocks when growth stocks have the edge. So while over the long run we want to be tilted to value the majority of the time, right now we have that flexibility to tilt towards growth. So that shows you where we are today in terms of our weightings. The next question is, well, how have we done? How have those weightings contributed to returns? And this chart will show you how that's done. So earlier in the year, we saw value stocks actually begin to show some signs of life relative to growth stocks. And I think, if you were reading the Wall Street Journal or seen other headlines, you might have seen some articles about the return of value. But it was never enough to really turn the longer term trend towards growth. And we saw starting in April, growth stocks really start to pick up steam again. So as you can see, we kind of went back and forth with the market. The gold line here and the gold bars here represent the overall market. We're using the Russell 3000 as a proxy for that. And the blue bars and the blue line represent the performance attributed to our size and style tilts. And so as you can see, starting in April, we started to see some separation, and that continued over the summer months and into September a little bit. So really what this slide is here to show you is that our size and style tilts year to date have been right. It's about 1.5 percentage points of additional return over the market. And when you hire an active manager, this is the type of thing you're looking to see. An index will give you really that gold bar, and what your active manager wants to do is be different than the gold bar. So this chart is designed to show you that month to month and over the entire year, we have been different than the market as a whole. But it's not all good news. We have seen some headwinds, and specifically those headwinds are around stock selection. We've been in this relatively long period of time now where we're seeing some correlations that are going the wrong way. So just as one example, one of the strongest factors that's associated to long-term returns are value factors, so something like a PE ratio. And what we've been seeing here recently is the PE ratio is correlating the wrong way. So companies that are more expensive are showing more returns, and companies that look like they're better deals are actually achieving less returns. And this is something that we've seen from time to time. We've seen periods of inversion like this happen. And it's something that we do have to wait out. Now, I will say this webinar is timely because we actually are building new stock selection models this week. We do that twice a year. And Lowell is actually heavily a part of that process of building those models, and he's on the webinar today. So I'm going to ask Lowell to share with us kind of what he's seen out of our stock selection model and what to expect from here.
Okay. Thank you, Andy. I feel like it's Christmas with the color codes there. So what we're looking at here is our evaluation of our stock selection process. We call that SCORE. And we divide the universe into high-rated stocks that are buys, middle-rated stocks holds, low-rated stocks sells, And we're looking at these over approximately 6-month intervals. And our method here is the first model that we publish, and we create models spring and fall. The first published model, we track its performance until the next published model. And we can see a continuous interval down through the years from 2001 to the present. And you can see at the bottom that there is an annualized return advantage that's pretty significant with the buys and the holds relative to the sells. And this is another part, a critical part of our process of trying to capture excess returns in the market. But as you can see in the delta column furthest to the right, there's periods where there's inversion of the relationship. The lowest scoring stocks will periodically outperform the highest scoring stocks. We've seen that recently in several intervals, actually, in the last few. It's a little bit surprising, the timing of these inversions. It's completely normal to periodically have those. But oftentimes, those inversions follow periods of market sell-offs. And as the market recovers, there's a move to the market toward risk. There's kind of, in the lingo, there's a risk on and a risk off. So in a sell-off, it's risk off. During normal markets, it's typically risk off. And then periodically, particularly when the market has had a big sell-off, the market aggressively flips to risk on. So for whatever reason, again, I don't really have a great explanation for what would cause the risk on over these most recent periods, but generally speaking, when score inverts, that's exactly what's taken place. And so we've kind of had to suck it up for several of these intervals. The good news is we track this on a shorter basis as well. There's evidence that the market has already begun its rotation back towards sort of its long-term norms, and the models that we're about to publish at the end of this week, I think, have an excellent chance of performing more typically, and where our high-rated stocks will achieve the greater return.
All right, thanks for that explanation, Lowell. We wanted to move on now back to just a couple of macro updates that we're seeing. So one update that won't actually have much of an impact on us, if any at all, is the Global Industry Classification Standards that's run by S&P and MSCI. Recently shook up the economic sectors. So you'll notice the telecommunications sector has actually gone away and been replaced by a sector named communication services. This move has been a long time coming, as a lot of telecom companies have consolidated with other, internet industries and media industries. For example, AT&T's acquisition of DirecTV highlights one such move, where the telecom companies aren't truly just telecom companies anymore. So it makes sense to move them. Where this might have an impact is if you're invested in sector ETFs, then you might have, be surprised to know that some internet companies like Facebook and Google are no longer in the information technology sector. They've been moved to communication services. So, it won't have much of an impact on our portfolios in the way we manage money, since we neutralize the effect of sector. Sector's, the third driver of stock returns behind size and style, and it's not nearly as consistent and cyclical as size and style. It's more random. So we just aim to neutralize the effect of sector. So it won't have an impact on us, but it is something to keep in mind if you're invested in other types of sector-specific ETFs. And Adam kind of showed this on his chart, where he was showing the year-to-date returns as well as some headlines. And his advice was good advice. Don't let the headlines really control your investment decisions. But one headline we've seen a lot here recently is regarding interest rates. The rise in interest rates has been one explanation for the recent bout of stock market volatility. We've had the president sizing the Fed in their path of interest rate rises. So I wanted to address this real quick before we move on to Bijal to talk about some year-end tax planning topics. So basically, the headlines don't usually have much nuance. So I wanted to kind of do a quick rundown of what we mean by rising rates. So the Federal Reserve actually controls short-term rates, and they've been on this path of normalization over the last couple of years, where they've been consistently and slowly raising rates on a set schedule. They've telegraphed to the market. They've been very transparent. And so those short-term rate hikes are already priced in to expectations. But what the Fed does not control are long-term rates. Long-term rates are set by the market and have two main factors. One are growth expectations, and the other one are inflation expectations. So what we've seen over the last couple of years is short-term rates rise and rise consistently, while long-term rates have, held steady or not risen by quite as much as short-term rates. And what that's done is it's actually caused the yield curve to flatten. And that's important. The yield curve is simply the difference between 10-year bond rates and 2-year bond rates. And the reason why we look at the yield curve is it's actually one of the best indicators we have that predicts recessions. And it's not a flattening of the yield curve that's important, it's when it actually inverts. And this inversion has occurred ahead of every economic recession since the 1950s. So this is something that you may have read about in the news. It's something that we've been watching closely, as it is historically a good indicator. But the reason for this market volatility recently isn't the short-term rates that the Fed controls. It's the fact that long-term rates have begun rising as well. And this is both, this has its pros and its cons. So on the con side, borrowing costs are increased for firms. And this is why you're seeing stock prices sell off a little bit. Just harder for them to borrow money for CapEx and other types of projects. And the other impact is on real estate prices. So we've seen a lot of home building companies sell off hard recently. And this has been a big reason why mortgage rates are increasing, property, so there's less demand for new houses. But it's not all bad news. If inflation were the driver of these long-term rate increases, that would be considered bad news. But inflation expectations have actually held steady. And it's been the expectation of stronger economic growth that is driving the rise in long-term rates. And this has done a couple of key things. One, it's a sign that the economic expansion is on solid footing and is expected to continue into the future. And relatedly, the yield curve has actually gotten a little bit healthier, and the yield curve itself has steepened a little bit. As you recall, when the yield curve inverts, that's a sign of a recession. But when it's not inverted, there's really nothing to worry about. So the upshot of all this is what we're seeing now is maybe like a resetting of expectations out there. Rates are rising and maybe some prices need to be reset to take that into account. But it seems like it's going to be short-term in nature, and I wouldn't be overly concerned about interest rates at this time. So with that said, I wanted to move on to our final topic of the afternoon. Bijal is going to run us through some year-end tax planning considerations as we approach 2019. Bijal?
Thanks, Andy. This becomes a really popular time for people to kind of look back and say, what should they be doing in the next couple of months to close out the year, especially around taxes. And in 2018, as you can recall, earlier this year, there was a big tax bill that was went into effect and had some very specific and major changes. One that's going to affect everyone, I think, is just deductions, right? Many of these itemized deductions that we were all taking before have been eliminated. We've been getting lots of questions around this. I think at a high level, some of them are, fees that people used to pay to their accountant for tax prep, fees that they pay to a company like the Bernie Company to manage their portfolio, state and local taxes. Those are three big ones that were affected. There are strategies in place that, unfortunately, we still have to pay for those items, but what's the best way to do so? What accounts should they be coming from? These are all things that to take into consideration, especially now knowing that the standard deduction has almost doubled. So if you are a single filer, the standard deduction has now gone up to $12,000. Married filing jointly has gone up to $24,000. So be aware of the deductions that are no longer going to be allowed for itemization as you're kind of doing an inventory going through the end of the year, whether you do it yourself, use TurboTax or an accountant. This becomes a great time to evaluate, what does your overall situation look like? The other big one that we help clients with this time of year is tax loss harvesting. This is a benefit that we have with many of our portfolios since we do own individual stocks. It gives us the ability to look at the individual positions, and if there have been some that even though your overall portfolio may be showing a positive return, there may be individual securities that we could take advantage of for the short term, selling within your portfolio, harvesting the loss for you. This is a strategy that works really well when individual equities are part of your overall portfolio. However, in order to be efficient, I think the one thing we all have to do is look at your overall investments, right? So we have access to the portfolios we may be managing, but to do an inventory of where do you currently stand in terms of what they call realized gains and losses for the year. And please reach out to us if you'd like to have an individual conversation about your situation, if there's things that we need to do very specifically to harvest losses. I would say in regards to harvesting losses, if you think forward, many people do save doing this till the fourth quarter, December specifically. I would say that to really be efficient, it's something that can be done throughout the year. So really evaluate how your investments are doing. This is something we do on behalf of all our clients throughout the entire year. But if you're doing it yourself or you have some other outside investments, something to be aware of. The third topic I wanted to talk about in regards to year-end planning and also due to tax law changes is charitable giving. So again, another item that we know a lot of our clients take advantage of in the fourth quarter, and they don't always do it just for the tax advantage. I think most of our clients that we work with and everyone here within the team, we do this for a greater good, right? There are causes that are near and dear to our heart that we want to help, and there are different ways that we can do so. Strategies that we see lots of people do is the easiest thing is to just write a check to your favorite charity, right? And your accountant will hold that receipt and use it as an itemized deduction in the past. If that deduction is no longer available to you, a strategy that we should be looking at is perhaps gifting stock if we're looking at a taxable account for you. For those that look to gift outside of a taxable account or from a retirement account, there's something called a QCD, Qualified Charitable Distribution from an IRA account. This is a great strategy for those that are subject to RMDs over the age 70 and a half, a way to help satisfy the RMD, a way to help a cause that is near and dear to you, and especially if it's looking at your overall cash flow analysis. So again, these are two items that have not gone away with the new tax law changes, so something that you should take a look at. The third and final strategy I would talk about is donor advised funds. So these are longer term strategies where people have kind of put into place to say that they anticipate gifting a certain dollar amount over a period of time. And then if we're going to do that, and if we still are benefiting from a tax benefit, are there other strategies that we could look at on the other side of the balance sheet that maybe we're going to increase your income for perhaps tax-free growth in your portfolio by doing a Roth conversion as an example. So I've only explained these at a very high level. There's a lot more details that need to go into each one of these categories, but I'd say these three things are really the ones that we talk about the most, especially in November and December of each year. So if it's something that you're planning on doing, please do reach out to us and we'll be able to help you with it. So that's all I had in regards to the year-end tax planning. So before we jump into your questions, I just want to make a couple closing comments. On behalf of the Bernie Company, we want to thank you for your time this afternoon. We hope it was as valuable and as educational as we anticipated. Brenna Surrett's email is now shown on screen in case you have some follow-up questions for us directly. So give us just a moment or two. We'll filter through some questions that we've received from you.
All right, great. So yeah, we do have a few questions that came in both before the webinar and during the webinar that we'd like to address. So one that we didn't cover directly in the webinar, but we did want to address, as it has been a question that's come up from multiple clients, is around cannabis companies. So as we know, we've seen some fantastic returns out of some of these firms and some fantastic volatility as well. Tilray is probably the most high-profile one, but of course there are others. As you may know, Canada recently became the first developed country to legalize marijuana for recreational use. So it is something that's a topic out there that probably shouldn't be ignored at this point. So yes, while we have seen fantastic returns, there still remains a ton of regulatory risk in marijuana itself. There's a lot of Canadian companies, a lot of people have been piling money into Canadian companies that work in this sphere. But from the US side of things, you know, there's still issues around financing, and there's still issues with the legality with it being illegal on a federal level, but there are some states that have legalized marijuana for certain uses. And one thing I would like to point out is, you know, for years, the way that the U.S. federal government classified marijuana, biopharmaceutical firms and universities have not been able to experiment and run controlled scientific studies. So a lot of these purported health benefits of cannabis, they may be true, and the science may bear that out, or the science may bear out that there's a ton of hype here. And certainly there likely will be some practical applications on a medical side, but there's all these claims about all the medical benefits out there right now that truly have never been scientifically proven. So it's going to take years to get there, and it's still going to take some, you know, regulations to come off the books for this to be something that is experimented with in the same way that any other drug would be. And we simply don't know what the utility is. You know, and the other thing that you have to consider is there's very few companies in this space that are publicly traded. And because there are so few, and there's a ton of interest in it, the prices have been driven up beyond what they should be based on the fundamentals. So when we're talking about investing, earnings are something, and earnings growth are something that we look at. And yes, many marijuana stocks promise fantastic earnings into the future, but price is the other key consideration. And when you look at some of the price multiples that these firms are trading at, it just doesn't make sense. The type of growth that would need to happen is so astronomical, it's hard to fathom. So simply in the public market space, from a price standpoint, it's tough to justify. We've seen these kinds of you know, things occur in the past. A couple years ago, it was 3D printing stocks. More recently, it was cryptocurrencies like Bitcoin. And we've seen pretty quick, you know, bubble and then burst cycles occur. You know, Bitcoin is probably the fastest one that I can think of. So, you know, this would certainly be something that we would classify as speculative, and we would probably want to avoid in our portfolios for many reasons. But we did want to address the question while we had you all here on the webinar. And of course, if you have any further questions or would like to discuss further, you can follow up with us. We do have another question. So with this volatility, if I wanted to lessen my equity exposure, what suggestions can you make, and should I? So Bijal, do you want to address that question?
Yeah, that's a great question. I think you know, the first place to start with, I think, is to look at, when you think about risk, is there are two different measurements of risk. It's the risk that you're willing to take and the risk that you need to take to obtain your goals. And they're not always the same thing. So one of the tools that we use with our wealth management clients is really to quantify the two of those and to be able to kind of come up with what's the required rate of return that you need to achieve your goals, and work our way backwards to saying, how do we reduce the risk? And then from there, incorporate in other asset classes outside of equities. And in that example, we would look at a high level using a balance of equities, bonds, cash, and alternative investments.
All right, great. Thanks, Bijal. And all right, I think, yeah, we did have some repeat questions. So I don't see any other new questions on the list here. So with that, we've taken up about 40 minutes of your afternoon. We promised to make these things, you know, within 30 minutes to an hour. So I think we're going to go ahead and end the webinar here. You know, as I mentioned, if you're interested in getting access to the new client portal, please email Brenna, whose email address is still here on the screen, and we'll leave it up here for about 5 or 10 minutes following the conclusion of this webinar. And if you have any other questions about what was discussed today, then please follow up by calling our main line or your advisor. All right, thank you.
Thank you.